Overview. Lesson title: Finance vocabulary every lawyer must know. Target audience: lawyers and law students seeking foundational finance literacy. Format: free continuing professional development, CPD, micro lesson for YouTube. Objective: equip legal professionals with essential finance terms, explained simply and with legal context, to boost confidence in commercial, litigation, and transactional work. Key learning outcomes. By the end of this lesson, viewers will be able to recognize and define core finance terms encountered in legal practice, understand the practical relevance of these terms in contracts, negotiations, litigation, and compliance, apply finance vocabulary in conversations with clients, opposing counsel, and financial experts. Why finance vocabulary is crucial for lawyers. In today's legal landscape, finance vocabulary is not just a bonus skill. It's essential for effective lawyering. Whether negotiating M&A deals, calculating damages in litigation, or advising on company law, lawyers constantly encounter financial concepts that underpin the very structure of their cases. For example, understanding how companies are valued is fundamental in mergers and acquisitions, where lawyers must interpret financial statements and assess the implications of terms like EBITDA or working capital to protect their clients' interests. The language barrier between law and finance can be costly. A simple misunderstanding of a term in a contract or settlement agreement can lead to unintended obligations, financial risks, or even legal disputes. In real-world practice, this means that a lawyer who cannot confidently discuss financial matters may miss crucial details, overlook hidden liabilities, or fail to spot opportunities for their clients. Ultimately, mastering finance vocabulary empowers lawyers to communicate effectively with clients, opposing counsel, and financial experts, ensuring that legal advice is both accurate and commercially sound. Assets are what a company owns. Think of things like cash, buildings, or equipment. For example, if a tech company owns a fleet of delivery vans, those vans are assets. This matters in situations like insolvency, when a company can't pay its debts, because assets may need to be sold to pay off creditors. Liabilities are what a company owes to others, such as loans or unpaid bills. If that tech company has a bank loan, that's a liability, and knowing the total liabilities helps lawyers assess risks in deals. Equity represents ownership in the company. If someone owns shares, they have equity, which entitles them to a share of the profits and a say in important decisions. This is different from debt, which is money borrowed that must be paid back, often with interest. For example, if the tech company issues bonds to raise money, that's debt, and lawyers need to check the terms to avoid default scenarios. Revenue is all the money a company brings in from selling its products or services. If the tech company earns $100,000 from deliveries in a month, that's its revenue. Lawyers look at revenue to understand a business's value, especially in contract disputes or when calculating damages. Profit, net income, is what's left after a company pays all its expenses. Think of it as the bottom line. For example, if a bakery earns $10,000 in revenue and spends $7,000 on ingredients, rent, and wages, its profit is $3,000. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It's a way to measure how well a business is performing without certain costs. Imagine the bakery's EBITDA is $4,500 before subtracting interest on a loan and taxes. Working capital is current assets minus current liabilities. It shows if a company can cover its short-term bills. If the bakery has $8,000 in cash and $5,000 in bills to pay soon, its working capital is $3,000. CAPEX, capital expenditure, is money spent on big, long-term purchases like a new oven. OPEX, operating expenditure, is everyday spending, such as buying flour or paying staff. Finally, cash flow tracks the actual movement of money in and out. If the bakery collects payments from customers but delays paying its suppliers, it could have positive cash flow even if profits are lower. Crucial for understanding financial health in legal cases. A balance sheet is like a financial selfie of a company, showing what it owns, assets, what it owes, liabilities, and the owner's equity at a specific point in time. Think of it as a snapshot taken on December 31st to see the company's health at year-end. In contrast, the income statement or profit and loss statement covers a period, like January to December, and shows how much money the company made, revenue, and spent expenses, highlighting the top line, revenue, and bottom line, net profit. Interest is the cost of borrowing money. For example, if a company takes out a $100,000 loan at 5% annual interest, it pays $5,000 each year. Lawyers often negotiate whether interest is simple or compound, which can affect damages or contract terms. WACC, weighted average cost of capital, is the average rate a company pays for its financing, blending the cost of debt and equity. For instance, if a company funds itself half with loans at 4% and half with equity expecting 8%, its WACC is 6%. This figure is crucial in valuations and fairness opinions, helping lawyers assess whether a deal is financially sound. 1. True or false? Assets are what a company owes to others. A. True. B. False. The correct answer is B. False. Assets are what a company owns. Liabilities are what it owes. 2. Multiple choice. Which of the following best describes equity? A. Money the company borrows from a bank. B. Ownership interest in the company. C. The company's cash flow. D. Amount paid in taxes. The answer is B. Ownership interest in the company. Equity represents the owner's share in the company. Scenario-based. A company earns $50,000 in revenue and spends $30,000 on expenses. What is its profit? Net income. A. $80,000. B. $30,000. C. $20,000. D. $50,000. The answer is C. $20,000. Profit is revenue minus expenses. $50,000 to $30,000 equals $20,000. 4. Multiple choice. EBITDA stands for A. Earnings before interest, taxes, depreciation, and amortization. B. Earnings by investment, taxes, dividends, and assets. C. Equity before interest, taxes, dividends, and amortization. D. Earnings before interest, taxes, debt, and assets. The answer is A. Earnings before interest, taxes, depreciation, and amortization. 5. True or false? CAPEX refers to day-to-day operating expenses. A. True. B. False. The answer is B. False. CAPEX is for long-term investments. OPEX is for daily expenses. 6. Multiple choice. If a company is funded 50% by loans at 4% and 50% by equity at 8%, what is its WACC? A. 4%. B. 6%. C. 8%. D. 12%. The company's WACC is B. 6%. This is calculated by taking 50% of the cost of loans, 4%, and 50% of the cost of equity, 8%, then adding them together. Mastering key finance vocabulary is essential for every lawyer aiming to navigate the increasingly complex world of business and legal practice. Understanding terms like revenue, expenses, profit, EBITDA, CAPEX, OPEX, and WACC not only enhances your ability to interpret financial documents, but also empowers you to communicate more effectively with clients, colleagues, and financial professionals. This foundational knowledge bridges the gap between law and finance, enabling you to provide more comprehensive legal advice and make informed decisions in cases involving financial matters. By integrating these terms into your daily practice, you strengthen your professional toolkit and position yourself as a more versatile and valuable legal expert.